Disney parks were a major bright spot in the results, with our next guest saying that the union single-handedly drove the upside for the company. Daiwa Capital Markets America senior research analyst, Jonathan Kees. Jonathan, thanks so much for taking the time here with us this morning. All right, parks, resorts, how did that play out in the quarter from your perspective? What type of runway does Disney need to create going forward?
Sure. First, thank you for having me. In regards to your question, parks and resorts, they've been the saving grace. It's ironic. They were what sunk the company during the COVID era, during the lockdown. Now they're what's lifting the company. So this is the beauty of having a diversified business is with economic times. Yeah, the strengths will offset the weaknesses, and that's what's happening right now with the cyclical business. Supposedly there's a recession going on. That's not happening at the parks. Parks are going straight. I think what's important is that they're talking about reservations are still quite strong, kind of through the roof. They're not looking to change things too much. Even the cruise ships, the cruise ship that just was launched last month, that's now profitable. So the cuts that you've been talking about in your discussion so far is going to be mainly in the media segment. So right now there's two segments. There's parks, the physical stuff, the resorts, hotels, cruise ships, and then the media and the DTC. That's where the cuts are going to be. Most of it, of that $5.5 billion that Iger talked about, will be in content, but the others, the staffing, the 7,000 will be in back office or in marketing in those areas. So media is facing the macro challenges of lower advertising in this supposed recession, as well as subscriber cuts in terms of cord cutting. And parks will continue to lift up, I see, in the foreseeable future. This December quarter is seasonally strong. It was just seasonally stronger than everyone expected, and that lifted up the results.
So, Jonathan, just to linger on parks for a second, it sounds like you don't think they need to cut pricing. I mean, is it too expensive to go to DisneyWorld, Disneyland, the other parks? Is that a problem for them?
Yes and no. So what this does is it makes them exposed mainly to the upper to high-end consumer segment, which are feeling less pain from inflation, from the economic pressures. But Disney, part of Walt Disney's mandate has always been accessibility, has been always appealed to the masses. So what Iger talked about, and what you kind of touched on, is having basic prices expand the number of days. So Iger actually talked about it in the call. 15 days was what was provided in terms of off-peak bottom rock pricing, theme park pricing previously. Now he's expanded 50 days. They're all basically going to be off-peak when it's less crowded, but at least there's more choices if you're coming in on a tight budget.
Jonathan, did Bob Iger do enough to keep Nelson Peltz off this board?
I think it's interesting how that has directed. First, I'll take a step back. Some of the feedback I've gotten from my clients that I've even read about is that Bob Iger stepping in was going to throw in the kitchen sink, just declare a bad quarter and lower expectations and go up from there. I think Nelson Peltz came in and changed the dynamic. Bob Iger had to change everything, show progress from day one. So rather than the kitchen sink procedure, which is what a lot of new CEOs take when they come on board, he just started with a stellar quarter in terms of results. And previous quarter, they missed on both bottom and top line, and just start talking about cost cuts in terms of bringing back the dividends. So that was one of the things that Peltz had talked about, is shareholder return, capital allocation is bringing back the dividend. That is acquiescing to Peltz. Now, Peltz wants more. He wants to actually control some of the strategic direction, even the creative direction of media. They're saying he's not qualified. So I don't think that fight is going to take place. The proxies have been sent out. Shareholder meeting will be next month. At this point, that fight is still going to take place.
So, Jonathan, real quick on this fight. So you don't see Peltz selling his stake given the pop in the stock price. You see this going right up to the annual meeting in April.
I think so, yes, because he's still saying it's worth a lot more than currently. He has less power, less leverage now because the stock price has gone up. since Iger has come on board.
Jonathan, just kind of similar to that, though, Iger had said that Nelson Peltz doesn't understand our business. Does this change, this restructuring, make it easier or harder for every investor to understand Disney's business?
I think this restructuring makes it a lot easier, especially for the activists. So one of the things that previous activists had pushed for was the selling of ESPN. And that's been also echoed by previous investors voicing criticism. ESPN is a central part of the strategy for Disney streaming, as well as just the cable business. And Iger made it clear he's not selling it. And I disagree with the comment that one of my peers had said selling a percentage of that. They like to have complete control. We haven't even talked about the option to buy the remaining part of Hulu that they don't control from Comcast. But they separated it in order to let people know how well ESPN is doing. Other than that, the whole business is the same. They're just giving more P&L responsibility and distribution responsibility to the creative content within the media group. But the only thing different from the previous structure that is still currently in place is that they just broke out the ESPN unit.
Yeah. Did they set ESPN up in order for somebody to be able to come in and take a stake of ESPN?
I really don't think so. They like to have complete control over the creative aspects of it. They like to dictate how things are put together. They are under pressure to do something about the stake that they don't control in Hulu. And previous management commentary from Disney has been they're interested in buying out Comcast. And when you have two big players controlling something, it's hard to say which direction to go if they disagree. So that's why a lot of these joint ownership of properties, while it's less risk financially, it's more risk strategically and creatively.
All right, we'll leave it there. Top analysis here for us on a very important day. Jonathan Kees, Daiwa Capital Markets America Senior Research Analyst. Good to see you. We'll talk to you soon.